Hello everyone. Good afternoon. Some of you might know we like to start these on time and end these on time. So, with that said, I know a couple other people they're continuing to join here, but we'll get things started here. Of course, I'm David Levy, one of the partners and financial advisors here, and have the pleasure of hosting and proctoring today's conversation. But today we have our Chief Investment Officer, Mike Horwath, running the meeting and having a really informative discussion. We'll try to keep this to about 30 minutes. Like I said, we try to start these on time and end these on time, so we will do our best to do that today. As many of you are aware, we like to do these quarterly to keep you informed and up to date of what's going on in the markets and sort of what our investment team is thinking about behind the scenes. But everyone is muted. If you have a question, please put it into the the Q&A box, or message me individually, and we'll save some time here at the end for Mike. But with that said, I'll allow Mike take it over from here. Thanks, everyone.
Awesome. All right. Thanks, David. As David said, my name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. This is our normal quarterly market and economic update. A little shameless plug. I do also a newsletter on a quarterly basis. So that was sent out earlier this week. So if you didn't have a chance to read it, it's a longer read. It's intentionally that way, but a lot of what we're talking about today is put more into a written form and broken down that way. That way, if it's an easier read for you, or you want to read something to fall asleep to, good luck. But it's available for you if you like to read it. So this is our normal, like I said, quarterly market and economic update. Certainly plenty to talk about, but let's jump on in. It's a lot of the same, and there's some new stuff for us to go through. So it's always exciting. There's always something to market, right? Everybody's always like, I always crack up because my family's always like, given the market conditions, are things normal? Are things different? I'm like, good markets, bad markets, there's always something to talk about, right? It's always something for us to work through. And that's the way I think people should always perceive it and should approach investing. There's always something. Much of the same is inflation and the Fed, right? The inflation and the Fed are going to be and have been the most important pieces to markets, to the economy, to where things are going. So from an inflation perspective, I think an interesting part, we'll talk about it shortly, is we got an inflation report this morning, and it was about what was expected. The good news is inflation does continue to come down, but we're still above the Fed's target. The expectation was not that the reading this morning would be down to the Fed's target of 2%, but we are continuously moving down. We're just still elevated above where they want to be, which means interest rate hikes are still on the table. But inflation has come down. We're still above the target. And look, with inflation being above target, that means rates are going to continue to move up. They have moved up. And where we sit today is the Fed funds rate, which is that short-term rate that the Fed uses, is at 4.75 to 5%. Right? They use a range, right? The lower bound range is 4.75, the upper bound range is 5. Right now, markets are pricing in a 75% likelihood that the Fed in early May, which is their next meeting, will move that to 5 to 5.25, right? 0.25% upwards. That's where the markets are pricing in. There's been some changes to what the forward expectations are, but beyond the May meeting, but markets are still pricing in one more rate hike as of this morning. The banking sector, when we're talking about what's new, the banking sector in March is something new. It's something for us to discuss, and there's been stress at the regional bank level. We'll dive into what happened, why it happened, and what it really means, right? That's the most important part. So I think people, who lived and who really were investors and who had jobs during the 2007 to 2009 period, all of a sudden it's kind of PTSD as to what that all means. We'll dive into that, and we'll kind of speak to that in more detail. But by and large, markets have been choppy all year. The good part, stocks and bonds have both been positive. There's been a little bit of a bounce. Coming into the year, our belief was that bond markets were going to be a good place to be coming off a very tough year. They've started that way, and we expect them to continue to be that way. One interesting thing is when you look on the right-hand side, so much of our conversation is this hard landing, a soft landing, or no landing. What that means is the Fed is trying to raise rates and trying to get inflation down without pushing the economy into a recession. So when someone says a hard landing, they're referring to the Fed getting inflation down, but pushing the economy into a recession in the meantime. A soft landing is the opposite, right? They can get inflation down to their 2% target and avoid a recession. And this is what the debate is. Can they do that? Is there a path to a soft landing? What you see on the right-hand side here is the Atlanta Fed. They do a real-time GDP tracker. The green line refers to their estimate real time. And what we saw coming into the end of Q1 is that they're projecting, Q1 to still be a positive GDP environment. The expectation is not for Q1 to be a rough quarter from economic growth perspective. That doesn't mean that Q2, Q3 likely won't kind of keep pushing downward, but we're not in that environment where economic activity is severely limited. Let's jump in real quick to asset classes, right? What happened from a return perspective in the first quarter? As I said, really across the board, you'll see that the second from the right column year to date, global stocks up about 7.3%. A little bit of a reversal was international stocks, at least on the developed side, especially Europe. Europe was up about 11% in Q1. International developed outperformed the US. What happened in the regional bank space in March really hurt the small cap space because many small cap, especially value stocks, have sensitivity to the regional bank space, along with regional banks in general fall into that small cap value-ish type of landscape. So we saw small cap take a little bit of a hit. So smaller companies underperform bigger companies. We saw international developed outperform the US, at least when it comes to Europe outperforming, US large cap and US small cap. As I mentioned, another good part has been the bounce back for the bond market. We all remember 2022, we saw a negative 13.01% for the aggregate bond index. So it was a very rough calendar year with interest rates moving up as much as they did. But coming off of that, our belief still is that it's a good entry point for investors who are owning bonds through the end of the quarter. They were up about 2.96 on the taxable side. So that's the governments, corporates, and securitized, which is mortgage-backed securities, And then on the muni side, we saw about 2.78. For the US aggregate bond index, that number is up above 3% so far year to date. So, and that's through yesterday. So we're seeing this bounce back. Part of it is bond yields coming down, and part of it is just investors being compensated now with starting yields on your bond portfolio being higher. So across both spectrums, we've seen bonds bounce back. But across the board, given everything that's happened, right? Inflation still being hot, a regional bank issue, both the equity and fixed income markets have continued to just kind of work their way through it, and both are positive in the single digits so far year to date. So what's happened on the inflation front? Because I think this is a good place to start. A lot of this is going to start and stop with what the Fed does. The good part is progress has been made on the inflation front. The important part is what the Fed does with raising rates, which slows the economy, or it's intended to slow the economy, and pulling back on rates, which is something that can help stimulate the economy. It's going to be driven by what inflation does, and really what the labor market does, kind of conversely. But this morning, we got a report that core CPI, which is inflation that does not include energy and food prices, is down to 5.6%, which is about where it was in February. That's a year over year figure. So March of 23 versus March of 22, still above that 2% target. But given where we were back in September at 6.6, still moving our way down. We haven't made much progress so far from February to March, but as the year progresses, we do expect that to continue to move down, especially because lower rental prices will start to get baked into that figure. Shelter, which is a lot of rental and home prices, that is a huge part of the core CPI measure. And it's just something that takes a little while for it to, those numbers have come down, but they take a while because they're on a lag in the way in which they're added back to the measure. Headline CPI is where a lot of the progress has been made. It's been coming down from 9.1 back in June of 22 to this morning, it was down to 5%. What you saw is year over year and month over month, energy prices coming down substantially, which has been a huge part to the overall measure of headline CPI finally kind of coming down. The problem still that the target is 2%, right? And the Fed's going to be a little bit flexible. They may live in that 2.5. They may be okay with 3. They're not okay with 5. They're not okay with 6, especially if it's a longer prolonged situation. The good news is that we're seeing cracks in what's caused inflation, which has been mostly widespread, but we're seeing different cracks along the way of things that are starting to break and flip over and come back down to earth. A big part, you'll see it on the right-hand side. I always like this graphic. It's durable goods versus services, right? Because if you think about the different components of CPI, you have more of the goods space, like how much a refrigerator costs, versus more of the services space, which may be healthcare and things along those lines, insurances. You also have shelter, which ties into rental costs and housing prices. If you look at both of those spaces, we've seen goods, which is the blue line, take off and really start to come back down to. In the wake of the pandemic, if you look at consumer spending, especially in 2020, the late 2020s, early 2021s, that's what people spent their money on, right? They spent so much of their money on goods because services weren't available. You also saw so much of the bottleneck from a supply chain perspective in the goods space. So the combination of people spending less on goods, more on services, along with supply chain just improving, we've just seen this massive reversal, and goods are now coming back down to earth, and they're contributing to kind of this disinflationary space and trajectory. What you still see are services that don't include commodities, just services, less commodities, just remain sticky. And if you look under the hood of what that mostly is, a lot of it ties back to the shelter conversation. Until the new rental prices, and if you look, we have a graphic on this, another shameless plug in that newsletter from a quarterly standpoint, that shows rental prices. If you look month over month on a more real-time basis, those numbers are coming down. The problem is those numbers for rental prices don't get added into the CPI bucket until it's a lag, right? There's a lagging effect on that. So we're going to see improvement on the services space. It's just going to take some time. It's going to take time throughout the rest of the year. But if goods continue to do their trajectory and then those rental prices and housing prices start to form a crack and start to come down a little bit, we'll start to see inflation at its highest level start to really come down. And then the Fed, which is what the market's anticipating, right? What the Fed will do will be based upon that, which is likely potentially raise rates one more time and then take a pause, right? Stop that hiking cycle and start to look at, well, where do we need to go from here? But that's where we're at from an inflationary perspective. This is the story behind that. High inflation has forced the Fed to really hyper inflate the interest rate space, right? They've really had to push interest rates where, for perspective, coming into this, interest rates, that range was 0 to 0.25%. They really couldn't go any lower. What they've had to do over the last year and a half has been pushing that figure up to 4.75 to 5%. What does that do? Naturally, it makes debt more expensive. It makes buying a house, buying a car, doing all this stuff more expensive. Taking out loans for small businesses, it slows the path of the economy. That's the entire point, to bring down inflation. What it also did, though, when you have higher rates like this, it affects financial markets and financial market prices. So stocks and bonds are tied to interest rates in some way. Some things more sensitive to others. What we saw was both stocks and bonds negatively affected. Longer term bonds, higher growth stocks were affected more versus more stable, high quality, more mature businesses, and short term bonds were less affected, right? Because the longer term your business is from a stocks perspective or longer term from a bond standpoint, the more affected you are by the movement in interest rates. But that's the story, right? This graphic of how much and how quickly the bond market priced in higher yield because of what the Fed had to do was such a factor in what happened in 2022. The good part is the market is starting to settle in, and we're starting to see this move down a little bit as we're starting to price in not only the Fed pausing, but now potentially cuts moving forward. A wrench that was thrown into this was the whole banking situation. Right? Volatility in the banking sector obviously brings back concerns over what happened back in 2008, and that's kind of a whole separate conversation. But what we saw in March were multiple banks, really, the highlights were Silicon Valley Bank and Signature Bank ran into liquidity problems. And the Fed, the Treasury, FDIC had to step in to really take that over and help prevent a run on their deposits. What you will learn is that this is not a systemic problem. When I say systemic, this is not every bank is going to run into this problem. If you actually look at the top 5 to 10 banks in the country, they actually fall into a different category because the Fed, the Treasury, they've deemed them almost pretty much too big to fail, and they have certain requirements that they must live under. Right? Those are the JP Morgans of the world. A different world from an asset-based standpoint. What you learn and what you see is that a combination of factors resulted in this. One, Silicon Valley Bank, it's a small regional bank based obviously in Silicon Valley, and it catered to the businesses of Silicon Valley. High growth tech, venture capital. The problem with that are those are types of businesses that are burning cash flow on a quite a consistent basis. It's not my checking account, right? My checking account fluctuates, so much every month. Yours likely does the same. Your savings account does the same. They're sticky assets. A high growth business like a venture capital firm or high growth technology companies, they can burn through cash at a pretty quick pace. And when you look at the demographics for their type of business, they didn't have mom and pop investors. They didn't have me. They didn't have my parents. They didn't have you. They had these high growth tech stocks. And what you see is that as the withdrawal base started to draw down on, they were forced to have to liquidate securities. And what does that mean? Well, if we go back to what we just spoke about of what happened with the bond prices of 2022, a bond that started the year at 100, at the end of the year was now worth $87. So now they have to go and they have to go sell bonds, which are high quality instruments. So most of these are government bonds, but they're having to sell them at a loss to raise cash to pay out their depositors because so much of their deposit base is highly concentrated into a very volatile industry. That's what happened with Silicon Valley Bank. They were forced, and they were so underwater with so many of their bond investments that they had to sell them. And all of a sudden they couldn't meet their deposit requirements. So the Fed stepped in. They actually started to protect investors above their $250,000 FDIC mark, which most of their depositors were. I think that is a very big difference as well. So much of their deposit base was outside of that FDIC insurance, whereas many other of the big banks, they have so much because of the mom and pop investor that are within that $250,000 per account limit. This is not a systemic issue. It doesn't mean that there won't be more issues, that other regional banks won't come across similar issues. But the problems that happened with Signature Bank, which had a crypto side to it, along with Silicon Valley, which was a little bit in the crypto world, but mostly it involved early stage technology in general, and really those high growth venture capital type firms. It was a very kind of focused on that specific bank. And that's how we think this thing will happen moving forward. It's not a systemic issue where 2007 to 2009 saw a systemic banking and debt issue. This isn't that. This is a specific company, a couple companies that had a dislocation for what they were using to invest in their deposits and what happened in 2022 and not managing their risk very well. There may be other regional banks that come across this. And I think that's the most susceptible part of the market, right? Smaller regional banks. But what's been clear is that the Fed, the Treasury, FDIC, they stepped in and they're going to protect investors and they're going to do what they need to do to make sure that deposits are available. And they've actually made some tweaks so that other banks have access to liquidity if they so need to in situations like this. So from an equity perspective, just to jump in, what happened, you've seen some of the returns, but I think the moral of the story is it's been a give and take year. right? Coming off a year where really it's been commodities and cash performing well, we saw a lot of the asset classes so far this year, which is going to be shown on that yellow bar on the right-hand side. That's January, and then February is the pink bar. You saw things bounce back pretty well. It's kind of been in lockstep with what happened in 2022, meaning the things that got hit hardest in 2022, especially the high growth, longer duration assets, they bounced back well here in 2023. But it's been a lot of give and take, right? For as good of a month as January was, February took a little bit away. And despite everything that happened in February, we saw March actually be another positive month for most, not all, but most of equity asset classes. So the main takeaway really is, the market is skittish right now, because what you saw in March was concern over economic conditions. Whenever you start talking about banks and the availability of credit for businesses, people start to get a little concerned over economic conditions. But the main takeaway is markets bounce back. Markets have largely worked through that, and they're going to continue to be data dependent based upon what economic conditions and indicators show, what the Fed does, where inflation goes. All of these things are going to contribute to what happens in equity markets as we move forward. On the bond side, I really just want to highlight a couple of things. I think what happened in 2022 when bond markets at its highest level were down 13% for the calendar year. On the left-hand side, what you see are the Fed policy over the last several rate hiking cycles, right? And the graphics show how much they moved and how quickly they did it. What I want you to focus on is the red squares, right? What the red path shows you is how quickly and how much what the Fed just did was. For perspective, back years ago, they moved the same amount, 425 basis points, but they did it in like 18 months longer period. So what they did last year and over the last 18 months in general has just been extremely quick. And this is why we've seen so much volatility. The positive side to this is the right-hand side. What you now see, this is yield to worst, right? This is the yield on various asset classes within bonds. The moral of the story is those numbers, if you looked back in mid to late 2021, were substantially smaller. Investors are finally being compensated to invest in bonds and to get that yield that really they need, right? Because investors want the yield. And now what this does is it also helps protect during equity market drawdowns. So despite what happened on the left-hand side, which has been very, very quick and quite big from a magnitude standpoint, the good part is on the right-hand side. This is why we believe coming into the year, why we believe we saw what we did in Q1. Bond markets are much better positioned to withstand whatever's really thrown at them moving forward at this point. So what's our outlook? I think the Fed and inflation are going to be very important. I think we're clearly towards the end of what's going on from a rate hike perspective, but the attention now goes to what's going to happen with spending and earnings, right? Earnings are going to be very important because corporate profit margins are contracting. You're starting to see layoffs happen to help preserve those margins, which were really wide. They're going to compress. Earnings expectations are still high. Can they come out and can they meet them? And it's good from a timing standpoint because you're going to start seeing corporate earnings really roll out over the next week or two, quicker and quicker across many of the sectors and industries within the U.S. But economic data is going to lag what the Fed's doing. We're going to start to see some of the effects of these higher rates. And the whole idea is to hopefully avoid a recessionary environment. The economy will slow, but the Fed is just trying to avoid pushing that economy into too much of a recessionary or too much of a slowdown environment. From a positioning standpoint, what I would really highlight is we're still overweight U.S. over international. The U.S. dollar is still strong, but it's weakening, right? It's something that we're keeping an eye on because as it continues to weaken, international equities get a tailwind, and it's something we actually want to take advantage of as that happens. But we're pretty defensive still. We're in a wait and see environment, so we're more defensive in our equity positioning, our stock positioning, because we just don't see the benefit to being in a very high risk on environment right now, just given where the uncertainty level is, and given where economic indicators are, and the fact that we don't know so much of what's going to happen, we just need to be diversified, and we're leaning more defensive, overweight the U.S., overweight U.S. large cap, and dividend producing stocks primarily. And on the bond side, we're similar, right? We're high quality. We're more investment grade than we are below investment grade, meaning we're higher in government bonds, investment grade corporates, high quality mortgage-backed securities, things like that. High yield, you saw on the previous screen, high yield bonds are yielding 7, 8, 9%. They just carry more risk. And when economic conditions worsen, they'll be the first things to sell off. And when default rates pick up, you run a higher risk of not getting your principal back. That's not the type of return stream we want. So we're just higher quality right now. From a tactical standpoint, on the bond side, we have actually sold our inflation protection as well. That was something that we had on a lot of last year. If you remember, we have since sold that because we just feel like that inflation protection is pricing in about what we expect markets to do from an inflation perspective, and we don't believe that there's a need to have that at this time. So I went through a lot. David, I'll pass it over. If there's any Q&A, happy to address. I know we have a few minutes left, but happy to go through anything that may have come up.
There was a couple things in here. I mean, one was on the banks and should we be concerned? I feel like you touched on that, sufficiently. But if there's anything else you want to touch on, feel free. The other one that you very loosely touched on, but we've been getting the last couple of days, is the devaluation of the U.S. dollar and what our expectation is, and what are we doing, with portfolio adjustments or not doing in light of that.
Yeah, both good questions. So I'll start with the bank one because I did hit on that quite a bit. Anytime you start hearing a run on a bank or insolvency, 2008 wasn't that long ago. It's naturally a big concern. I think the key is banking crises usually occur from a credit standpoint. Default rates pick up, poor underwriting, things like that. We saw derivatives being a big part of what happened in 2007, 2008, 2009. That's not what happened here. This was more of an isolated incident with a couple of incidents with a couple of banks that had very unique clientele that we don't believe is a systemic issue, right? Because most banks don't. I caveat that by saying what regulation since the financial crisis back then has helped conditions. We look at all of the credit conditions and the different banking ratios that we can look at from a liquidity standpoint. Things are in much better shape than they were back then. I think credit standards are much better, and what you're seeing are banks doing what they should do. They're starting to tighten credit standards. They're doing the little things. So we don't see this as a systemic issue. It's not to say that another regional bank maybe won't have an issue, because smaller banks are just more susceptible to unique idiosyncratic issues. But the U.S. Banking sector as a whole, we look as very healthy. We do not expect it to be anything close to what happened in 2008, just because the situation is different. It doesn't mean you won't hear from this again, but it's something that we certainly don't think will be the primary driving factor of markets falling here in the near future. On the U.S. dollar side, it's a great question, because on the U.S. dollar side, there's a couple concerns, right? People are starting to catch wind that the U.S. dollar has come down from its high. Additionally, you start to hear rumblings of Saudi Arabia selling oil contracts to China in their local currency, right, rather than forcing it being done in U.S. dollar, and concerns over the U.S. dollar devaluing. Right, there's things like that have come up. Here's what I'll say on the U.S. dollar: it should not surprise anybody that in general the U.S. dollar depreciates over the next decade. The U.S. dollar, especially in 2021 and in 2022, had gotten extremely strong. A big part of that is because interest rate differentials matter, right? So if the U.S. is paying a better interest rate than other countries, which the U.S. is pretty quick to raise rates very quickly relative to other countries, you're going to see a natural strengthening of your currency. Well, that's going to start to unwind because the Fed's pretty much done or close to done, and the rest of the world is still kind of methodically going through it, especially the Eurozone, the UK. So that's not a surprise. Investors should expect the U.S. dollar to depreciate. what does that mean for portfolios? So what will do well as the dollar depreciates? I think really one thing that we're going to look at is international equities. It's a place that, I know I mentioned it. It's a place that we've been underweight because of the strong US dollar, because of the better fundamentals here in the US. But as we kind of flip to a more risk-on environment, when we start to see the conditions improve from just a global macroeconomy perspective, international equity should get a tailwind for US investors as the dollar depreciates. It's an area that we expect to add to. We'll be very selective in where that is, whether it be more developed, more emerging. But that's one thing that we'll look at. You can also look at things like precious metals. It's not something that we lean into heavily because from our perspective, the risk return scenario for precious metals is just not a very attractive one. Usually your long-term return is inflation. But if someone is looking to really hedge their risk, that is an area that they can look to on the US dollar front. But look, the dollar is going to depreciate over time. It's been strong. It's done that. Anybody who's lived going in from 2000 to 2010, you actually lived through a time where the US dollar went that, depreciated quite a bit. But we'll look at different areas, especially being focused on international equity and maybe precious metals, but it's just not an asset class that we really look at too much.
Cool. Thank you, Mike. And, in the effort of trying to end this on time, thank you everyone for joining. If you have any questions, additional questions, please reach out. We will be happy to get those answered. And, of course, we will continue to share our message and these videos and information to you with Mike's newsletter. There's another plug for him. I think that's up to 3 for this, but through our social media and our website, we'll continue to keep you informed because that's important to us. So thank you again for joining today and have a great rest of your day.